It's been 84 years.
Sorry man, I can't help myself, but I must play that for a video like this. So anyway, I know a lot of things has happened over the past week or so, and even the sky agrees with me. But I think I just wanted to really preface this. Firstly, I'm not a geopolitical expert, I'm not a macroeconomics expert, I'm also not any policy expert. So I'm just doing very good old bottoms-up analysis. It ain't much, but I think it's honest work. That said, I think I'm an expert in the like button. Gently tap that like button. I think that's all I asked for. So before we dive deeper into understanding why the market is reacting so violently, so let me just give you a very brief overview on the sequence of events, essentially explaining what the heck happened to the Chinese market over this past 4 or 5 days.
So on Monday, the 23rd of September, after the Hong Kong market has closed, there's this special announcement that they're going to hold a joint press conference amongst these 3 separate divisions. So Governor Pan from PBOC, which is the central bank or the People's Bank of China, the NFRA director and the CSRC president. And they will mostly talk about financial support on Tuesday before Hong Kong market opens at 9:30 AM. And there were 2 distinct groups of investors that were speculating what this joint conference would be about. Of course, the ones in the bullish camp were talking about this potential bazooka stimulus that were to come, which in hindsight did happen. And on the other hand, the skeptical bunch said that it might potentially be a nothing burger again. So fast forward to Tuesday on the 24th of September, there were a slew of measures being introduced to F your puts. Sorry, I didn't mean to put that in. It's to basically instill market confidence. So what were the measures being introduced, you might ask? I think this was a great summary done by Hao Hong. So China actually unleashed powerful policy combo to support the market and economy this morning. So a 50 basis point cut on the RRR ratio, providing a $1 trillion renminbi long-term liquidity, a 20 basis point cut on the 7-day reverse repo, a 30 basis point cut on the medium loan facility. They did mention that in terms of the RRR, they can cut another 25 to 50 basis points before year end. So we'll skip point number 5. Next, the deposit rates will also be lowered to neutralize impact on bank margins. And number 7, they also intend to lower existing mortgage rates. And on top of that, they even throw in additional measures like for the second property down payment, they reduce the down payment required from 25% to 15%. And for those of you who are asking what does RRR means, what does medium loan facility means, how does the reverse repo rate cut affect the economy? Long story short, is basically to increase liquidity in the system, make borrowing cheaper, incentivize spending, and to kickstart the multiplier effect in the economy. So on top of this slew of measures that was introduced, I think the most important trigger, which was skipped in the previous slide, which was point number 5. Basically, the PBOC providing $500 billion in funds to buy stocks. And there's a supplementary comment from Governor Pan where he said that if $500 billion is not enough, then we can do another $500 billion. Long story short, they're basically telling market participants to BTFD. And if you don't know what BTFD means, it means to buy the effing dip. So as posted on my IG story on the same day, and I'll just attach a screenshot somewhere here. So some of you might ask, what does this $500 billion entail? And I just wanted to quickly explain the mechanism of this so-called unlimited funding to prop up the stock market. So PBOC, learning from the Fed in 2008, is working to release liquidities for China equity market by allowing listed companies and major shareholders to borrow funds at a rate of 1.75% for share repurchases or increasing their holdings. So this strategy also mirrors Japan's approach from the past. Moreover, the central bank is also enabling brokers, equity funds, and insurance companies to swap positions, starting with a renminbi $500 billion phase, with additional tranches in the pipelines. So some of you might ask, what does this swapping means? Borrow money in this case is really by pledging their existing holdings to the central bank and then take out even more funds to leverage up on the balance sheet of the central bank to buy up more equities. So in a way, you can see this as some sort of a financial engineering to buy up equities, to show up confidence and to make the stock market just go hallelujah. And that's why every player in the market is trying to front run this. And I believe this phase 1 of this injection of $500 billion RMB is not even introduced into the market. I guess all the hot money and speculators are trying to front run this news, and they're probably just testing the resolve of the government on how serious they are in trying to prop up the market and to what extent they want to push the market. So this move actually allows entities to mortgage stocks to the central bank for cash, which must be reinvested into equities, essentially boosting market liquidity. And And implicitly, PBOC is just basically telling everybody, I'm going to pump my stock market. So with them stepping in and providing unlimited ammunition, this marks a historic moment for the China A-shares market. So if you're a major shareholder in a listed company with a 5% dividend yield, the opportunity to borrow at 1.75% to increase shareholding is a compelling option for strategic growth and value creation. So this analysis is written by the managing partner of RateGate, one of the asset management in China today. So I think there's a nuance here where you look at this on a superficial level. If a company is able to generate 5% dividend yield and I can leverage up my balance sheet and to borrow at 1.75%, I can easily arbitrage this 3.25%. I think the bigger worry here is really when you talk about many of these companies, whether it's A shares or H shares, giving out dividends, your Alibaba or Tencent, your Chinese banks, whatever it is. The worry is really when an economy go into the downturn, especially if people believe that it's the Lehman moment of the Chinese property market and the Chinese economy by extension, then earnings of many of these companies will probably take a hit. And this 5% historical dividend yield, we are not too sure whether they are able to commit to that. And if they're unable to and they start reducing rates, that's when it gets tricky. But that said, let's not forget, the lender here is the Chinese government themselves. They probably have a lot of innovative strategies under their belt to move around this market. So the bottom line, it's really their F your puts and don't fight the Fed moment. So moving on to Wednesday and Thursday, we actually get headlines coming out from Bloomberg and speculations of how the government is intending to inject capital to the top banks of nearly the quantum of 1 trillion RMB. And the China Politburo, which is the leadership team of the CCP, held a special meeting to discuss the economy. And there is also a change in the tone and the way they're talking about the property crisis. So now they're focusing on, and I quote, to stop property prices from falling further, which is starkly different from home is not a speculation but for a living mantra previously. They also talk a lot about policy supports for the capital markets and how it's an extremely important part in terms of policy design. And there are also various policies being introduced, such as giving out one-off cash handouts to people in extreme poverty, which might have limited impact, and I'll explain further. So the results, Hang Seng Index is up 13.13% in the past 5 days, and the CSI 300, which is the Taobao version of the S&P 500, they track the top 300 Chinese companies. They're up 15.71%. The FTSE A50 Index, which tracks only the A-shares market, they're up 15.66%. And I think one of the widely followed index in the American market, which is KWEB, the Chinese Tech Index, they're up 20.5% in the past 5 days. So suddenly, everyone on my feed is turning bullish. I scroll through X.com, I see people making hundreds of thousands of dollars from Chinese-related stocks. And I believe most of them are probably trading the volatility and they are employing crazy option strategies. And the last time I actually saw Alibaba above $100 is actually November of 2014. Sorry, I think that's a different topic altogether. But as you know, there's a lot of volatility in the Chinese market today, a lot of excitement from both speculators, traders, and investors alike. I'm not too sure where this will land, but I'll give you my conclusion later on. So recently, if you bought any Hong Kong or Chinese stocks, you'll probably be up. So unless you have managed to predict the stimulus within a reasonable time frame of maybe the past 2 quarters, then I think it's probably all luck. So like myself, I've been trying to position my portfolio into the Chinese market for quite some time now. I did not know when exactly the stimulus will come. But largely speaking, I think if you do believe into the mantra of being greedy when others are fearful, and when a bull market can only be born on pessimism, I think we are right around there. I can't say for sure, but at least that's my own position and my own viewpoint. And I know it's exciting, especially when you see your portfolio up like 5, 10, 15% every day, especially for those of you who are holding more speculative ones. They can be up 15, 20% daily, but it's not necessarily a game that we do play as investors. Specifically for those of us who position a lot earlier, I think we have been in this position for more than 3 years now. Having a 20% on a single position, if you divide the KGO over 3 years, that's pretty much a waste of time. So we'll talk more about how I'm thinking about this in the later part of this video. And just a quick plug, for new users to Moomoo's platform, they're currently running their events campaign period until the 15th of October, and you can get a starter kit worth up to 1,000 Singapore dollars. And all you have to do is simply just first deposit a minimum sum of $3,000 or $10,000, complete the minimal buy transactions, and you can get the different rewards tier. And on top of that, as you see interest rates coming down, If you complete your first subscription to Moomoos Cash Plus, which is the money market fund, you can actually get 6.8% per annum guaranteed returns for the first 30 days. And it applies to your first 80,000 of your holdings. So for those of you who still don't have your Moomoo account, I don't know what you're waiting for. It's really one of the better deals that I've seen out here. And on another note, for Seeking Alpha, new subscribers get to enjoy 7 days free trial and $25 off your premium membership. And if you don't subscribe before October 1st, at a 214 discounted price, prices will be revised upwards to $299 after October 1st. So you want to secure your REITs today. I think link will all be in the description below. But anyway, here's my non-expert take on what's happening in the Chinese economy today. So there's a general consensus that the Chinese government is now very serious in stepping into the market. There's a notable change in terms of policy stance, government stance towards housing, equity, stock market, etc. etc. However, there are still two main concerns here. Firstly, it's really this idea of leveraging the central bank's balance sheet, and it's not a long-term viable solution. So this is akin to injecting morphine to a struggling patient. So unless you can lever up to infinity like the US, if not, what they're trying to do is really hopefully in the very, very short term be able to kickstart this flywheel of a wealth effect on all asset classes, so as to drive optimism, confidence to their local players, whether is it the investors, the fund houses, the institutions, or even just the general consumers. I think in my previous video, when I talk about Ray Dalio speaking about the gloomy outlook of the Chinese economy, I think it's quite obvious to know and to empathize of the fellow Chinese people, where you see salaries stagnating, some of them are losing their jobs, the property wealth effect is working in reverse as they see their net worth dropping in real time, and just the stock market in a slump over the past 3 to 4 years. Nobody's feeling rich, nobody wishes to consume and spend more money. So that's generally how they're kind of stuck in this scenario. And by injecting this morphine to the struggling Chinese economy, they're hoping to kickstart this flywheel effect. Secondly, I think it's really the idea of fiscal implementation and effectiveness. So remember the cash handout that we talked about previously? That's a lot more targeted at consumption. They're basically just putting money into their pockets and telling people to spend that money. Don't save that money into your banks. But that said, let's not forget that money is fungible. So if I'm expecting some sort of payments coming in from the government, if I have some sort of earned income or dividend income or rental income, I would save that amount of money and spend the government's money. And net, I might not be consuming more. So there's really this I guess, conundrum and this worry of how effective many of these fiscal policies are in trying to trigger demand. And we are probably going to expect more details to come out in the following weeks. But especially in the current size they're talking about, whether it's 500 billion, 1 trillion RMB, it's less than 2.5, less than 5% of their GDP. So there's a lot of big numbers being thrown around in RMB terms. But don't forget that China is a big ship that has been correcting costs for 4 years now. It's probably not going to be easy, but I'm not saying to lose hope. Specifically, at least for myself, I'm still extremely hopeful and optimistic of China's future. So underlying this whole charade, they need to restore confidence first, and it's probably the hardest step. And I think on the other side, when we want to listen to what the bears are currently saying, the thesis is simple. So if China starts injecting large-scale liquidity, especially when it's the first time since the 2008 global financial crisis, it might actually signal certain alarm bells or red flags. So I think in one of the previous episodes when I talked about some left tail outcomes of countries that underwent similar bubble bursting, I think namely, or the classic example is Japan, either went through hyperinflation because they print their way out, nothing else is taking off to replace that gap, or a deflationary scenario, which is the last 3 decades Japan has experienced. So I think the current rally is a little bit unsustainable. There's a lot of speculation, a lot of hot money gushing in. They're trying to front run these expectations and basically money coming out from the central bank. So here's my theory. When I look at the capital flight episode out of China over the past 3 or 4 years, it seems to me that many of these capital are seeking for non-US exposure. So they probably went to India, they went to Japan and other parts of this world. And if you can't see a new equilibrium being established, if you don't see capital flowing back, then maybe there might be some trouble in the medium term. Secondly, I think in terms of technicals wise, right now everything just looks like it's flushing up, everything just going up 5-10% daily. But specifically for Alibaba, I think there's still a high hurdle at around the 116 to 125 mark. Because it's not necessarily the first time where we see Baba quickly revert from 60 to 120 and then going back down to $70 again. So I'm not a technical expert, but this is basically just simple lines that I've drawn on my technical chart itself. And also, I think many people are still skeptical and bearish about the overall market. I presume there will probably be a lot of profit taking along the way especially for Baba, because of that price action. But long story short, that's not necessarily my concern, especially for those of you who take a much more longer time horizon approach. So here's my conclusion. I think anything can happen in the short term, and I've been a perma bull in Chinese tech in multiple occasions, and I don't see why my view will change right now, barring any, I think, World War III or just China invasion or stuff like that. So it's not the first time that we are seeing sharp rallies from 60 to 120, and although I must say that this time do feel different. The tone, the measure, the overall climate, the context is different. It's more sustainable than the hit and run 2 years ago. Anything can happen in the short run, especially such volatility, looks a little scary, and it seems like everything is extremely overbought. So then the natural question would then be, when do we sell? I don't want to go through that process of my positions doubling and then losing all the gains again and sitting through a very trying and challenging 2 years. To me, I really don't see it that way. I think you really need to know your approach to this whole investing into the Chinese equity space. I do know of very vocal people on X.com saying that China bulls are probably one of the stupidest bunch of people. I vehemently disagree. To me, right now, I'm taking a long-term approach. I'm looking towards how Alibaba, Tencent, and the likes of those Chinese companies that I have in my portfolio, how they're able to strengthen and expand their economic moat, how they're able to compete with their competitors, how they're going to take advantage of some of these fiscal measures that's going to be implemented and to earn more profits, to build up their cash flow, to return money back to shareholders. These are what I'm focusing on. And if you do really just focus on Baba, I think anything under 150, I'm not remotely interested in selling unless I need to raise cash. My price targets specifically for just Baba and Tencent, they're still easily another 50% or 100% from here. So that's why I don't like to provide a hard cap and to do a hard take profit, because it's not necessarily my approach, and I really just want to see through this entire growth trajectory with the companies themselves. And I do look forward to their contributions to AI, to cloud, to consumption, to finance, to gaming, etc, etc. There's so much more potential that I'm looking towards, so I'm really not interested in trying to just trade in and out for 10-20%. And likewise, I'll focus my efforts on the company's execution and their earnings report. And I did publish the previous video of Alibaba's $100 billion problem. And I'm squarely focused in seeing how they're able to deliver these numbers. So if you really think about it, nothing much has changed to the underlying company this week compared to the previous week. Although you can make the case that the macro environment is different as policy steps up, but I think it should be reflected in the numbers. And I guess if you look at the technical charts, you look at how investors are trying to front run everything, they're trying to expect something to come in maybe the following 2 to 4 quarters. I don't know for sure, but I'm just saying I have been a perma bull. I'm still holding tight onto my position. I do look at this as a step in the right direction. I think in the short run, a lot of crazy things can happen. Baba and Tencent can go back to their COVID lows again. Who knows? Some of you might want to take profits, sell covered calls, buy puts to hedge your position. But I can tell you for a matter of fact, I'm not doing anything. I'm sitting on my hands. Continue looking forward. With that, I'll see you in the next video. And hopefully in 2024, I can finally say that I'll see you on the moon. Goodbye.